Hello everyone and welcome to your Masters in Governance. My name's Sandy and today we'll be discussing Module 4, which is about finance and decision making in public organizations. Today we're here with Mr. Sammout, who will be sharing his financial expertise on the topic. Mr. Sammout, thank you for being with us today.
Thank you for inviting me.
All right. So I'd like to start off with an introductory question. What is finance all about?
Okay, if we have to actually depart from the theoretical actual definitions of what you find in the books, I would define it as that particular subject which gives you, I would call it like the barometer, or a thermometer, which sometimes you don't really, let's say, appreciate that you have it, but when you need it and you want to know what the weather is, you will go into that barometer and you will know whether it will be raining tomorrow or it will be sunny tomorrow. So for me, it's that instrument, so to say, which gives you all the necessary indications, whether you have enough fuel, whether your battery is charged enough, if we have to compare, with a car, for example. So it's that particular aspect, function within a company, within an organization. Let's say it's not a subject because it is a subject, but now we are actually applying what we learn into something real. It's that particular function, that particular area within a company which gives you all the necessary indications that you need to run your organization, let's say, in good health.
Okay.
That's like something very basic, very minimal. I would definitely see the finance function as an overall function within an institution. It's not like, there is the sales function, that people are definitely, focused on what they need to sell. Then there is like the marketing function, which helps the salespeople and creates like the environment, the demand for the product. The finance function plays like a little bit of a back office role. It's not visible that much. People in finance are not usually pretty much visible. They tend to be at the back office. Sometimes they don't usually talk to people a lot. Not everyone. But definitely they are actually analyzing a lot of data coming from the different areas of the entity. And they actually, once this is combined in a proper way, that gives you like the health of the organization, the indicators that you need, whether you are selling enough, whether you are actually converting the marketing effort into the sales. So it is like a support function, for all the other areas of the organization.
Okay. All right. Thanks for that. And for my next question, could you explain the broad aspects of financial statements? So what do they represent?
Yes.
How can we construct them?
Yes. If we have to go, let's say, the academic route initially, there are definitely standards, international accounting standards, and supported by international standards on auditing, which will gives you that, so to say, level of comfort when you are actually producing financial statements. These standards are needed so the end user, or any user actually, if they are looking at the financial statements of a company and they want to compare or benchmark with any other company's financial statements, the way they have been prepared by the accountants and audited by the auditors, they follow the set of rules, and based on those set of rules, you know that the figure that you are actually looking into followed a certain set of standards, a certain set of rules. Just to give you an example, if you are looking at the turnover figure, which is an extremely important figure, very much looked after by everyone. Everyone wants to know how much we are selling, what is our turnover. So it's an extremely important figure in the financial statement. There are obviously, it depends on the industry, obviously, whether it's a leasing company, whether it's a construction company, but the principle behind that figure is that you are actually following certain rules, certain standards to ensure that what you are reproducing in the financial statements covers only that particular activity which which has been carried out during a specific period. So if we are doing January to December financial year, we know that any contracts which we signed, for example, but that we will be starting building them, these projects, the following year, you do not actually recognize any profits, any revenue for something which you haven't yet started. You might have a deposit for a construction project, but you will not benefit, so to say, from that contract unless you start billing based on actual works. So irrespective whether you have issued an invoice and you billed the client and the client paid you a sum of money, as long as you didn't perform any work, for example, you cannot recognize that figure. So if I am an external user and I'm looking at the accounts of construction company ABC and construction company XYZ, and I'm looking at their turnover, I know that since these have been audited by qualified people and prepared by qualified people, that figure is neither deflated or inflated. So it represents something which pertains to that particular financial year. The same can be said for other areas of the financial statement. So we have a number of concepts in the financial statements, like what we call the matching concept, for example, where you have to match your costs to your revenues within the same period of time. So you don't really, if you are incurring expenditure, which you are actually, you haven't yet built any revenue against it, that is considered like, for example, work in progress, because you haven't benefited from any revenue from that particular cost incurred. Then there are other areas. If we are dealing, for example, with a research and development company, for example, in the past there were a situation where any research and development costs which you will be incurring on a year-by-year basis until you develop a specific medicine, for example. So you are incurring a cost in the early stages of the development, so to say, and then you benefit from the revenue at a later stage. We have standard for that, which will guide us what we can capitalize and what we have to write off. Because then we have another concept which we call the prudence concept. Okay. And if you, for example, you are doing research and part of that research goes lost, you didn't actually achieve anything, you can't really capitalize that research. You have to write it off. It's part of your operating expense. It's a necessary evil. You have to do it, but you cannot capitalize on something which you will not benefit from in the future. So going back to the original question, if we are again comparing to research companies, pharmaceutical companies, we know that if they are actually capitalizing their research and development, there isn't any, hidden costs, inflated costs within that capitalized cost, where the company does not have any benefit which will arise out of that cost. So users, especially external ones, are guided indirectly, knowing that, someone else applied a set of rules, and based on those set of rules, one is actually seeing a set of clean, let's say, statements. Nothing is deflated, nothing is inflated. If we are dealing with another aspect of the financial statements, like, for example, inventory valuation, where people who deals with the sale of furniture, cars, tiles, what have you, fashion, things which go out of fashion. That's why there is the fashion industry. So if you didn't manage to sell your collection, you will know that you will not manage to generate the tag price which you have established actually when the collection was fresh. So if you keep carrying that cost, because part of it you didn't manage to sell it, there are standards, there are rules how you should deflate, so to say, eliminate part of that cost,
Okay.
If you think that you will not eventually recover through the sales period, if you think that you will not recover the original cost purchased, you have to actually write your losses straight away into accounts. Even if you think that you will be selling this next year, you haven't yet done the sale, but you know that you have to put these items on sale, so you will not recover anything except for a certain percentage, okay? Any losses that you will be incurring in the future, you will write them off today. So again, back again to the question, if there is a user who is checking what is your level of turnover, that figure gives you comfort, gives you confidence that it is the value which will convert and be able to, convert into a sales value. You will not achieve less than that figure that you are actually showing in your balance sheet. So, financial statements following this set of standards will definitely give you comfort, that what you're seeing has been, has passed through a rigorous, so to say, process.
Okay, thanks. And for my next question, it's how do we use the financial statements? Perhaps for decision making.
Yes. Definitely, we tend to split into two. There are what we know, what we call the financial accounts, the financial statements, those which are audited and those which are available mostly for everyone through the Malta Financial Services Center, for example. And then there are those accounts, which we usually call them management accounts, managerial accounts, which go into further detail, and they are intended for the internal user. If one has to just look at the audited financial statements without any additional notes to the accounts and, trying to understand and read between the lines, the information which you manage to extract from those figures might be reasonably acceptable, but it won't help that much the internal user with any decision making. Definitely, they will give you the broad picture. Is the company liquid enough? We would be able to say from the financial statements, but which areas are creating the hemorrhage, for example, you won't get it from those financial statements. You need internal accounting, records, accounting management accounts, which will direct you to the problematic area. What would you get from those statements? There are various aspects. We tend to deal with the profit and loss account, the income statement, the balance sheet, and the cash flow. Looking at them separately will give you very little information. They will, but it will be, not to the level that it is needed. So, but looking at the three areas of the financial statements altogether, you will definitely form a better opinion. You can link areas of the income statement to the balance sheet. Then you will understand, through the cash flow statement, how the cash has been utilized in the company, and so on and so forth. Then we can come to this later at a later stage. There are what we call ratios that we will actually look into them, and the numbers which come out of these ratios will give us, people who is definitely trained, and is understanding what is looking for first and foremost, and what that result is giving. But those results will give you the indicators that we mentioned at the beginning of this interview.
Okay, all right. Could you tell us a bit more about ratios and their significance?
Yes, there are different type of ratios. We have operational ratios, financial ratios, liquidity linked to the balance sheet, then other ratios which are from two areas of the financial statements, and when combined together, they give you, they give you the necessary answers which you are after. If we start dealing with operating ratios, for example, or percentages, it's not always a ratio in the sense of a number, but could be also a percentage. What is the relationship between one line and another? So what is the relationship between the cost of sales and the turnover? And which means what markup or what margin I am doing, what is my percentage profit, okay, that I am doing. We have definitely as well, however, we have to be careful that we don't look at percentages and we stop there. That's why it is important to understand what the financial statements are telling you and what are you actually looking for. You can make a 50% markup and you are earning 2,000 euro, and you can earn a 5% profit, gross profit, and you are earning 500,000. Depends on the turnover, depends on your industry, and depends on a lot of things. So definitely, 50% profit, gross profit, sounds very nice, but in absolute terms, what does that mean? So you can't really just look at percentages without also looking at the numbers, or looking just at the numbers without looking at the percentages. That absolute figure, if it converts into 1% for that particular industry, is it enough? Or you are expecting 3%? So besides the ratios, and we, for example, with operational ratios, we deal with gross profit, we deal with net profit after you write off, you record and recognize all your expenses, operating expenses. Then we deal with profits before taxes and interest, with profits after interest and taxes, and with final profits after dividends, etc. Why? Because you need to know what is your operating profit before any other stakeholders are actually eating further from that profit. So if we have these figures, for example, these ratios are used as well if you need to apply a performance appraisal system with you in HR. So if you have the operations manager, shop floor manager, factory manager, call it what you like, and he cannot actually be assessed on something if the company has borrowings with the banks. So if that company is paying bank interest, does it make any difference to the operations manager if he is operating with money from the bank or with money from the shareholders? So he cannot really be penalized, so to say, and you insert the bank interest within his operating overheads. So you need to assess that guy, that person, before any bank interest is paid. Also, the banks would be interested to know what is their interest cover. So you have managed to generate so much profit, that level of profit, how many times you can actually sustain your finance costs. So putting them before, not after, will definitely disrupt the picture. So obviously, the way the figures are placed, they have been taught in a way, which gives a clearer picture to the user, the internal user or the external user. Should the operations manager, for example, be penalized because you pay tax at 35% or you have incentives? His performance is not really related to how much taxes you pay. If the shareholders or the directors decide to give a dividend, is that an expense which has to be, assessed upon? No, it is a distribution of profits which ultimately should not affect, the judgment which you will give to your people. Then there are other ratios which will deal, for example, with the balance sheet. The balance sheet is structured between long-term and short-term. Long-term assets and long-term liabilities, short-term assets and short-term liabilities. Anything which is long-term is there to sustain the company in the long term. Anything which is in the current asset and current liability side, the short-term area, is there to help the company operating on a daily basis within a period of 1 year. So is it okay that I have a lot of properties but I don't have liquidity to work with? Is it okay that all my liabilities are in the short term, but nothing in the long term? So I am always, I always have people, knocking on my doors to pay them. So what is the relationship between the short term to the short term and the long term to the long term? We can't really put everything into one basket and, mix everything and what comes out, comes out. We need to match like with like. So we need to establish what current assets do we have, stocks, cash, debtors, and what current liabilities do we have. So we know our short-term commitments. Are we in a strong position that our current assets are higher than our current liabilities? Because otherwise we would have financial problems. Not in the sense of the company, whether the company is strong enough financially, but in the short term, if you have a lot of property, a lot of cash tied up in property or tied up in anything else, which cannot convert into quick cash, but then you have your liabilities, which are short term, how are you going to match that liability? So then banks come into play. They provide you with the necessary bank overdraft to work with. What is definitely true is that you should not mix your long-term assets with the current. For example, you don't go to the bank and you get a loan to build a place and then use that to buy stocks, because you are mixing, a long-term loan with short-term requirements, Why? Because actually, if you have to get a long-term loan against property, you are expected to start paying it back. If you then start using that as a bank overdraft, you expect, that you have that limit, that facility, and you can use it, which is not the case. At one point in time, the bank starts asking you the repayment. Yes. So if you are using it for the wrong purpose, you will start having problems, maybe not immediately, but after some time. Then there are other ratios which link like the operating aspect of the company to the balance sheet area. Like for instance, what net profit have we generated compared to our asset base, compared to our shareholders' funds. What is the return that the shareholders are getting? So it is the net profit, just to not get into much detail. Your return is the net profit, and compared to what you have actually placed in the company, because the shareholders' funds, the initial capital and the retained earnings, you left them there, so the directors, the managers can, generate that cash and convert it back into a higher amount of money. So what is your return? What do you do? Do you put your money into the bank and stay quiet, maybe taking very little risks, and you earn X%, or you put your money into a company with higher risks and you get a better return? Is that return justified enough compared to what the bank is giving you? So, looking at ratios, in isolation, just pick and choose a few without looking at a number of them, and try to see whether the cholesterol level, is actually being affected by high pressure somewhere else, Are they related, or that happen to be a one-off thing, So what these indicators, what these ratios are telling you, you need definitely to act and adjust in that particular area, which is creating you the issues. Another areas, for example, where you can combine operations to the financial aspect. What are your credit days and what are your creditors' days? How many days you're taking to pay your creditors? How many days you take to collect your cash? So you are actually looking into your credit sales, not cash sales, compared to your debtors, and then, I wouldn't go into the details here, but are we taking too long? Are we taking, are we matching if we are getting 90 days credit? Are we actually also collecting within the 90 days? And if we need to allow more credit days, is our overdraft enough? No. These are all areas that when you see them all together, extracting the data from the financial statements, and as I said, from the audited financial statements, you might not get these figures, because if you're looking at turnover, nobody will tell you, listen, I sold this on credit and I sold this on cash. So you wouldn't know what is your cash business and what is your credit business. So, that becomes an issue. But if you are actually looking and you have enough data, which is more internally, not externally, you will get the correct answer to your query, to your question.
Okay, thank you for that. And next, I'd like to ask about budgeting. What is it all about?
Okay, it's all about planning.
Okay.
You are actually forecasting a scenario, and I know a number of people who are afraid of doing budgeting. And the answer would be afraid in the sense that they don't really believe that much in doing budgeting.
Okay.
Because they will say, listen, but I cannot really forecast the future. No one can forecast the future. But would that mean that you don't try to plan? You at least do a tentative. And even if you don't reach your expectations or you exceed your expectations, at least you know that you are doing better or worse than what you have projected. There are many aspects of budgeting, and if we have to look into it, one of the biggest concerns, in my opinion, that a company may encounter is when the company looks at the budget as the job of the accountant.
Okay.
They actually leave, or pretend that the accountant does the budget for the company because it is a finance thing. So that's the accounting job. But the accountant would need the input of a lot of people. How much are we selling? At what price do we think we are going to sell that? The mix. What is my marketing effort for that? What would be my production costs? A lot of information, which without the input of all these, let's say, stakeholders within the entity, the accountant will not manage to come up with something reasonable. So we have what we call the master budget, and that's when the accountant will pick up all the singular budgets, the production budget, the marketing budget, the sales budget, and his job would be to compile it in a way which comes up with the global budget for the company. And once he manages or she manages to do that, we would be able to start adjusting, the profit is compared with, based on these figures which have been produced, the net profit is not realistic, is not enough as return for the shareholder. So what do? We try to increase the cost. Is that possible? What is the demand for the product? What are the competitors doing? Can we try to reduce the cost? Because sometimes to make more profit, we tend to try and increase the price. But can we reduce the cost? Maybe we cannot reduce the cost because it's a franchise that we are dealing with and the costs are imposed. But can we try to be more efficient somewhere else? Can we try to save on electricity, on fuel? Sometimes, that those petty savings will convert and add up and will convert into a better profit. So when we do budgets, we get into a lot of detail. Depends what the industry we are dealing with is, what are the future expectations of the market, whether we are expecting prices to increase, prices to decrease, what is the level of inflation. If you really want to do a good job in budgeting, there is a lot to go for, basically. But it's a plan how the company will be performing in the next few years. We split usually a budget, if you are well organized, and definitely you need to have competent people and a good team of people. This is not a one-man job, basically. But besides the the other areas, then the finance people who are compiling, and combining all the data, you need a good team. It's not something which can be done, artificially, so to say. So if you really need to or want to do a good job, you need to dedicate time. This is it. Okay. Something which obviously is a luxury sometimes, and it costs money. So investing in budgeting is definitely an investment. We usually do a 1-year plan, a 3-year plan, a 5-year plan, and big companies, I worked for big companies where we used to do also a 10-year plan. Obviously, it is not something which is cast in stone. No, as I said before, exactly, no one knows the future. So the next year, that 3-year budget becomes year 2, 3, and 4, and it's still at 3 years, and so it's a rolling budget. And in 3 years' time, it's still a 3 years budget, but it reflects always the current year and the next 2 years. So you don't do it once, you leave it there, and you look at it in 3 years' time, and you say, okay, what did I do? No, you look at the current every year. The 3-year one will always change and reflect the previous changes. But it gives you an indication, at least based on current assumptions. We have to make assumptions. We can't really work without assumptions. But as long as those assumptions are educated, educated estimates, because obviously sometimes you also have to deal with estimates, and we wouldn't know if there is a crisis of somewhere and cotton becomes a scarce product. Obviously, the prices of cotton will go up. But would I be able to? So I wouldn't go into something like that and start assuming that my products will go, will go up in price because something extraordinary happened. Because I will either increase my cost, I have to convert that and pass it on to the customer. Because everyone will be impacted with the same cost, increase in cost. So my problem is also your problem. The problem is when my problem is not your problem. Something which increases on my side, but not across the market. So that is something which affects you only and not anyone else. But budgets and standard costing, we tend to work a lot with standard costing, and we split even more the production cost. Is it the labor amount of hours that have to increase, or it's the cost of the labor itself? So it's the number of hours. It's always an equation: number of hours times unit cost per hour. So if the price, the cost of labor increases, can we become more efficient and balance that cost? Do we invest in machinery and maybe we save on labor? That cost of machinery, when we start depreciating it over the economic useful life of the machinery, will it compensate enough for the savings in the labor cost? Because now we are moving from labor intensive, for example, to capital intensive industry. So we are replacing labor, or we are adding labor and eliminating a machine. I don't know. It depends, on the circumstance. But that investment, what is giving me? Because now we are moving from something operational cost to something which is more of a balance sheet cost, a long term. So we have to now recognize that element of depreciation, because the investment is a long-term investment. It's a 5-year investment. It's a 10-year investment. And in 10 years' time, or in less time, we need to replace that machine. But the cost element, which is the depreciation element, is it less than the savings that we've done in eliminating, a certain amount of employees? So we need to, to match and compare. Going into the budgeting aspect and breaking it up into minor elements, the cost of raw material. Is it the quantity or the cost per meter of the thing. Do we have waste? What is our cost? Can we actually get into a better pattern where we save on fabric? I mean, I've experienced all this, with computers, which will give you percentage efficiency of a pattern, for example, and you get the initial pattern if you are dealing with textiles, for example, and you get a 90% efficiency in the design. It's not enough. So you then manipulate and you put pieces different areas, and the computer gives you 94%. I remember instances where we achieved like almost 100% efficiency, 99 point something. That means that when you actually reproduce the design onto the production table, and the machinery starts cutting, if it's a pair of jeans, for example, it starts cutting this part, it is so, designed in such a way that waste of fabric is minimal. And obviously that will push the cost down, So there are various levels of budgets. The high level ones, obviously very important for the people who are not dealing with the production, for the investors, for the managers. Where do we go? What are we expecting? And then obviously you need to compare with the actual figures. Otherwise, if you don't have budgets, you can't really compare. You just take it as it comes, and that's it. And then you can actually take it further down into different areas, and the more you get into detail, the more you can actually fine-tune your operation. And you have to be careful not overdoing it, because as I said before, time costs money, and the benefit that you are achieving from going into that minute detail is costing you money in offices, in people. So at one point in time, you have to stop somewhere which is acceptable to the organization.
So for my last question for today, it's about risk analysis and project evaluation. To start off with, what is risk and why is it important?
Definitely, risk is absolutely important.
Okay.
If you don't know your risk, you will be walking into an area with closed eyes as a blind man. So everything is black to you, and you hit the wall, and you don't even notice until you hit that wall.
So it's necessary.
But the thing is, in my opinion, there are risks and there are risks in the sense that as long as you get into something with eyes open and you evaluate your risk and what is this risk, it could be many. The risk could be many. But let's consider the risk from a business aspect. The main risk that you have is that you will not succeed with your venture, with your operation. Not doing budgets is already creating risk, so your risk is already very high. If you are actually starting something, planning of doing something, not doing market research, and sometimes we do it, we don't get into the necessary detail. We don't know our competition. So the less things we know, the higher the risk. Then there's obviously inherent risk that you can't really eliminate. If you are operating in a country which does not have political stability, the risk is also very high there. So at one point in time, you have a left-wing government. In a few years, a couple of years' time, because there's always a change in government. There's no stability. If we talk about Malta, we know that at least there is like 5 years. If you speak of another country, every 2 years there is changing government. And you will see it very close to us. So political instability, industrial actions, that gives you a lot of risks. So do you invest in a country where industrial action is always, in the news? What is the risk that you have people who are actually asking you for increases in salaries consistently, continuously? You can't afford that. If you don't pay that extra money, they will either leave to somewhere else, or maybe they stop working in doing the production. So then there is another risk, which like you do everything well, but the people will not like your product, or you are expensive, so you need to adjust. Having done a good planning exercise before, you would definitely reduce the risk. Is the risk bad? Is the risk good? Well, let's put it this way. Without a risk, if I have to do something which is risk-free, it will definitely gives me a very low return. So a risk-free venture and putting money into the bank, more or less, is the same thing. Or buying government bonds, more or less, if it's a risk-free operation, so might as well I don't do anything and put money with my bank or with the government at the stock exchange. So that element of risk, accepting it, will allow me, to generate a better return. Now, is it X% more, X% less something? Can it go lower than what I would have gained, putting my money into the bank? Definitely yes. If something goes wrong, you've lost your money, but at least you've lost your capital, and that's why a limited liability company gives you the benefit of compared to something else, because at least you put that sum of money into your company, and if you are a millionaire privately and you possess your own a lot of luxury cars, classic cars, villas, etc., that's the company and that's my property. No one will actually touch, what you have. But obviously, if things go well, you will because of that risk, that you are carrying, you are earning a better return. So risk is not bad at all. Otherwise, nobody. If there is no risk, there is no enterprise, and if there is no enterprise, there are no people working. So I wouldn't say that risk is bad, but definitely you need to not underestimate the risk. And if you do proper planning and forecasting and budgeting, you can also get into what we call sensitivity analysis. What is the best case scenario? What is a normal scenario? And what could be a worst case scenario if my turnover goes down by 20%? And what would be my cost impact? It might go down by less than that figure, So my profits will shrink. But up to what level? So if I say, listen, this could be my normal operation. I can be aggressive, I can achieve this. But things can also go wrong. So if I achieve less, and I cannot go less than 20%, because it would be very difficult, from market research, what would be my impact on my bottom line? And that takes us to somewhere else. What is the structure of my operating cost? Are they fixed? Are they variable? If they are variable, if I suffer a reduction in sales, I can actually get rid of variable costs. If my costs are fixed, and whether I manage to sell so much or less or more, I still have that cost. I don't know. For example, you have at least one security guard, and you need one security guard. That guard can be considered as a fixed cost, because whether you are selling so many units, less or more, you will still put that security guard at the door. But if you have then employees, part-timers, you can adjust depending on your production. So you need to know the structure of your costs. So when you do sensitivity analysis, now an area, if you suffer a reduction in sales in one particular area. I don't know, maybe you are actually producing type A and type E. If you get less sales from this product, can you switch your people to do the other one? Or maybe they know how to produce that thing, but they are not flexible enough. So a lot of things, get into, if you really want to be serious, doing sensitivity analysis, you need to structure your data in a way which you obviously you will get the answers as fast as possible. One trick with financial data is the quickness of getting that data. If you don't get data very fast, you might be losing on the decision aspect, the decision-making process. It might be too late. It might be history. We are producing figures which are at this point history. So decisions are based on something which happened 3 months ago. What's the scenario today? Is it the same? Is it worse? Is it better? Data which is old is no longer valid. Is no longer useful. So that's why, as well, before I mentioned that you need to have a good structure of a finance team, a finance structure, because if you don't manage to produce figures in a very fast way, might as well don't get them at all. That would be history.
Okay, and Mr. Sammut, that concludes the questions I have for you today. I'd like to thank you for your time today. So there you have it. Today we spoke about finance and decision-making in public organizations. Our key topics included the definition of finance, the use of financial statements, budgeting, and risk. That's it for today. Thank you, and see you next time.